Stephen LaFar,
Present.
Kevin Marcel,
Here.
Thurman Miller,
Here.
Andrea Hubbard,
Here.
Representative Pearson, Bobby Smith, and we do have a quorum.
Thank you for your knowledge of the pledge and character. I pledge allegiance
to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
If you join me in prayer, please. Father, we give you thanks for this day and the opportunities that we have to serve you and to witness to your word. Father, I pray that you would be with each and every trustee that's here today and those that are not. Father, I pray that our thoughts and our decisions would be wise and that they would be in the best interest of our system and of each and every retiree and active trooper. Lord, I pray that this meeting would be according to your will and would bring honor and glory to you. What's in your Son's holy and blessed name we pray. Amen.
We're going to public comment.
No cause.
All right. Approval of the minutes from the September 17th meeting, which would be under tab 1. Anything
Only comment I would make to you is on page 3 under other business. Letter A, that is revision of the schedule. We have received word from the PERSAC committee through the legislative staff that there will be a meeting of the PERSAC committee on November the 19th. I believe it's in the afternoon at 1:30. And of course, we'll have our investment committee meeting that morning. But the most important thing is that assuming that Mr. Hall shows up today for our meeting and makes his presentation on the actuarial valuation, we will have that approval to take to the PERSAC committee, and hopefully we'll be able to get our valuation approved and then be able to pay the drop interest rate, which is one of the most important things that this new schedule will allow us to do, to pay it before the end of 2014. It's not been the case in the last 4 or 5 years. It's drawn out into the following year. So this will enable us to do that. And on letter B there on page 3 also, I would mention to you that after discussing the issues of being the lead plaintiff there for Labaton and Sushiro and the relationship they were talking about having us be the lead plaintiff for Vocero Communications, the decision was made that we would not enter into that relationship as a lead plaintiff. We will allow our custodial bank to guide and direct us in that plaintiff situation. So just reporting back to you that we did not choose to do that, primarily because of the time and the potential for a lot of litigation issues that we might get involved in. Other than that, Frank, I think everything stands as presented.
all right. Can I get a motion to accept the minutes of the last meeting from anybody?
No
Motion by
problem.
Sammy, second by anybody, second by Thurman. Any objection? I see none. Try and do it.
You do have it?
Yes.
Okay.
Under tab 2, we should have
Well, my copies have the same news. So, looking at the flash report, so I'm reporting here, we're looking at the end of September 30. This first page, we've got your asset allocation. Just make the comment that the overall asset allocation looks good. If you slide down to the bottom, right above the pie, you'll see the total fund value at the end of the month, September 30, $610,587,929. So that's what we're working with here in terms of the value at the end of the month. Obviously, as we talked about, that's surely been impacted since the end of the month. However, that's where we were on September 30. If you flip the page, we can take a look here. This was up and down month, as you can see, overall. Little underperformance overall down. Let's focus on the fiscal year to date. I know you guys like to look at that fiscal year to date, kind of see where you are. If you slide down just that column and kind of looking at the managers, I'll highlight a couple of things, particularly in that first section. You'll see some underperformance. If you hone in on it though, what you'll notice for some of the managers is that they really are right on top of the benchmark. We did have a little outperformance with Aronson, but obviously the equity portion, this portion of the equity took a little bit of a hit. Moving on down, one of the bright spots, again, I'm focused totally on that fiscal year to date, I'd say one of the bright spots being relatively, Fisher was down 5.07% versus the Russell 2000 value down 8.58%, so offering you some protection as the market slid. Overall, let's look at your total domestic equity managers. We're down fiscal year, or currently down as of the end of the month, as of September 30th, down 1.67 fiscal year to date. So again, just down for the month overall. Taking a peek here at your international managers. Again, you've got some underperformance, but if you hone in on it, it's not necessarily. They're kind of right on top of the benchmark, some of these guys, like Templeton, down 5.83% versus the MSCI equity down 5.27%. So total equity, if we look at total equity, again, that's, the yellow band there. Total equity fiscal year to date down 2.43%. And on the fixed income side, Loomis Sales underperformed, Brandywine outperformed. Looking total fixed income down 1.09% fiscal year to date. So again, you've got some bright spots.
Are these returns gross or net of fees?
They're net of fees. So again, total fixed income down 1.09%. And looking fiscal year to date, if we flip the page, going all the way down to the total fund, fiscal year to date number currently stands as the end of the month down 2.18%. If you look at the policy index we measured against, down 0.97%. So some underperformance, again, a little bit of a rough period right now. As you'll see, we'll see how the adjustments come in this next month. One thing Rob wanted me to share with you guys that I don't believe you have, or I'm not sure that you have in your book, is as of the end of June 30, we've gone back and finalized all your numbers based on the late reporting we get in from some of your alternatives, etc. So he wanted me to share with you that as of the end of June 30, fiscal year to date, as of the end of June 30, the portfolio returned 18.07%. And the total fund value was $623,351,358. So that he wanted me to give that to you so you have that finalized number, with all that late reporting. And he wanted me to give you some good news as well. Any other questions I can answer about that report?
Thank you so much. Ms. Kristen.
The financials are under tab number 3. And this is just 1 month of reporting compared to what we had for last month, but much more complete as I have all of the statements that I normally have. So the first 2 pages are the September check register. I'll just highlight some unusual expenses. First, we had a medical exam for Robert Harrison, and a medical records request also for Robert Harrison. We had some legal fees that came through for the Klausner, Kaufman, and Jensen and Levinson firm. A refund for Mr. Justin Weeks. I think you'll find that the rest of the expenses listed there are all of our usual monthly expenses, payrolls and building, maintenance, and upkeep. The next page is our statement of net position as of September 30th. You'll see our net assets held in trust for pension benefits, all the way down at the bottom, the total $613,043,105. I'd also like to point out that, in order to provide you with these September 30th financials, we had to request that, our investment statements were dropped several days before, their normal 8 to 10 day business day range that JP Morgan is allowed. And so at the bottom, you'll see the asterisks that provide some detailed information as to which statements they had not received, that these were financials were reported without that updated information from Prisma, Portfolio Advisors, Aberdeen, and Aronson. Next is the statement of changes, and yes, you will see that unrealized loss there in that very first column, the very large negative figure, but we're hoping that this one proves to be better. That gives us a current month net decrease of $15,281,348. You'll see the net position at the beginning of the year where we started, the $622 million, and then where we are year to date today, the $613,043,105. The very last page is our budget summary, our budget actually for the 3 months ending September 30th. We look great in all categories except for that legal fee category. You'll see we're over budget there by a little over $9,000. And that's due to the additional legal fees for the litigation.
Any questions?
I'm also the next tab, which is the budget proposal for 2016.
Before we do that, can I get a motion to accept the financial report?
I'll make one.
Kevin, second by Anya. Any objection? See none? I'm sorry, Chris, do that.
That's okay. So under tab number 4 is that budget proposal for 2016. I just wanted to note a couple of things. You'll see we increased our salaries category, salaries related benefits category, and those are for the potential of possible merit increases, in addition to the normal increases in group benefits, insurance costs. We never know what those rates are going to be for laser, those employer contribution rates fluctuate quite a bit. So you'll see we went up a little bit there, reasonably of course. And then the next category that fluctuated was the maintenance and repairs. We went up by just $2,000, and then you'll see in our miscellaneous category, we went down by $2,000, so the net there is $0. We did add some expenses for recruiting per Irwin's request, and so you'll see we just went up $4,000 in that total operating expense category for our proposed for 2016 compared to our current budget for 2015. We went up a little bit down if you look in under professional services for actuarial fees, up a little bit for our normal increase for him, just $2,000. And then under our investment manager fees for our custodial and our managers themselves, we did an analysis of where we are now and tried to project out as best as we could with that. So you'll see our dollar change from the 2015 budget to the 2016 proposal is $265,000 overall, and a percentage increase of 10.6.
Any questions?
I'll just make a couple of comments. I think the budget is within reason. I've talked to some of the other directors, and most everybody is looking at increases as a result of the salary changes. Obviously, the investment management area is one that is based upon the total assets, and assuming we don't have a terrible investment year for 2015 and 16, I think these numbers are very reasonable. I will have some proposed changes to the actual relationships that we have with two of our current professional people. One is with our accounting people and the other is with our investment consultant. But I'm going to reserve those changes until after you approve this budget, which I would strongly urge you to do, and then I'll come back and request a couple of changes that will bring us in line with the proposed rates.
All right, any questions? Can I get a motion to accept the 2016 budget as presented?
Make more.
Motion by Kevin, second by Sandy. Any objection? See none, so moved.
If I could, in meeting with Stephen Griffin and Kristen this past week, in fact, it was this week, I guess, was it Monday morning, wasn't it? Yeah. So in meeting with them, we have held off doing anything with them in terms of any increases in payments there to them over the last few years, although in my mind, the workload has increased pretty significantly as we've grown and as the complexity of compliance and reporting requirements by the state and by the Federal Reserve has changed a lot of the things that we do. I received a letter from Stephen that I had requested from him authorizing us to go to a payment there. You see on the budget that you have in front of our accounting services are budgeted at $47,000. That allows for some fees that would be involved in the Gatsby implementation that we don't know exactly how all of that's going to work. But based upon the relationship that we currently have, I would like to recommend to you that we go ahead and increase our monthly relationship with Stephen and Kristen and their CPA firm to $3,750 per month. That would be a total annual payment to our accounting firm of $45,000. Still within the budget that we have proposed of $47,000, but it would be more than we're currently paying them.
Any questions?
Before we get a motion on that, I think we can approve both of these things. Let me give you the other one. The investment consultant is a line item that we've approved actually back in 2014. You'll see on the budget there again, summary going across or going down on the 2014 budget. We actually approved an increase to $120,000 per year for Rob Bickham and his firm UBS Prime Consulting. We have never implemented that simply because it never seems to be a good time to pay people more money. But one of those things that has become readily apparent is as we've grown so dramatically in the last 2 or 3 years, it is really an unfair situation that we're not paying him more. I happen to serve on the Methodist Foundation here in Louisiana and see all of the fees that we pay out to the consultants down there. Their system is about $150 million. They pay over $115,000 a year to their consultant. We're at $622 million and we're paying $100,000. I would like to recommend to you that we go ahead and implement that previously approved budgeted amount of $120,000 per year that would go to Rob and his firm. I talked to Amy about it as the chairman of our investment committee. Amy, I don't know if you had any thoughts or feelings that you want to
No,
add.
I mean, Rob does a great job for us. I sit on 2, 3 other boards, and we got a good deal for a lot less money. And for what he's doing and what we're relying on him, we're going more into alternatives, et cetera. I think that this is a warrant. Plus, we already, we agreed to it last year, so I think we need to implement.
So with those two changes, I'd like to get those approved.
Okay, that'd be an increase of $33,750 for accounting services and
$20,000
for investment.
annual increase.
And
And can I get a motion? Motion by Ms. Amy. Second by anybody? Andrea? Any objection? Let's see none. So we'll put ADB out in Charles.
I think he's out.
Bravo.
the whole
Hall. For President's request.
Lot safer.
Charles, you want to have the NC here, Charles?
Oh, no, I'll sit wherever you'd like.
You can sit right over there. Charles is pretty complimentary where he goes.
Just don't walk off with that,
Welcome, Mr. Hall. Would you like a water or something?
No, I'm good, thanks. Are you ready for me to start?
Yes, sir, I'm ready. Everyone's ready. I'm ready.
Well, for you, those that may not know me, I am Charles Hall. I'm the actuary for the retirement system. And what you have before you is an annual actuarial evaluation that gives you a report on the financial stability of the pension fund relative to its liabilities. You've already heard from your investment request the stability of your assets. So now we'll take a look at the liabilities. So if you would, I would like for you to turn to the cover letter, which is nothing more than an acknowledgement that I have relied upon the data that I've received from the staff and your external auditors relative to the financial statement in preparing this valuation, and I have prepared the valuation in accordance with the applicable Louisiana revised statutes that apply specifically to the Louisiana State Troopers retirement system. I would now like for you to turn to page 3, and we'll come back and look at page 2 in a little bit. Actually, page 4. The reason I'm skipping pages 2 and 3 is I thought it would be more beneficial if we reviewed the legislation that passed during the last session, because it had a rather substantial impact on how the system is funded, along with certain benefit structures. The most important piece of legislation that we had with regards to funding of the plan was in Act 399. Actually, Act 399, main purpose was to provide pension PBI or COLA reform legislation. And what I've done is given you a little outline, a little synopsis of what actually happened in Act 399 relative to how we grant these permanent benefit increases going forward. So this actually takes place for any future PBIs that the board may entertain granting to the retirees and disability retirees and survivors. What you see is a comparison of the old law versus the new law. The old law basically indicated that we could take excess interest earnings, those are earnings above the discount rate. Our discount rate is 7%. So if we had earnings above 7% under the old law, we would split the excess in half. Half of the excess would go towards reducing the employer contribution rate by amortizing that excess over a period of 30 years. The other half would be deposited in the experience account, and we would accumulate those funds until we had sufficient funds and had met the criteria for the board to grant a permanent benefit increase for the retirees. Act 399 changes that, and it changes it in several ways. We still look at the excess interest earnings above the discount rate, but before we split the excess interest earnings in half, we're going to take the first $5 million of excess interest earnings, and we're going to dedicate that to the oldest amortization base that we have on record. And we will apply it to that oldest amortization base without re-amortizing, which basically means that we're going to apply for the outstanding balance. And if you don't re-amortize, what that basically tells you is that we're going to shrink the duration of, it's sort of like prepaying part of your mortgage so that you don't have to pay it as long, a long period of time. So it introduced this initial $5 million excess before we put in the excess above that. And we call that first $5 million the hurdle. That hurdle will be indexed based upon the rate of return that the system earns on an actuarial basis in the years coming. So next year, if the actual rate of return happens to be 8%, then this hurdle will be increased by 8%. So $5 million will go up 8%. So once we've cleared the hurdle, if we still have excess interest earnings left, we would take those excess interest earnings and split them in half. Half of it would be applied to reduce the employer contribution rate, just as it was done in the old law. We amortize it over a 30-year period and it reduces the employer contribution rate. The other half is now allocated to the experience account with certain caveats. We're allowed to take that, our half of the excess interest earnings that are allocated to us, and deposit it in the experience account to the extent that the amount of money that we put into the experience account does not exceed an amount necessary to grant one PBI. So that's the second thing that the legislation introduced, was a cap. And the cap is we can't keep more than the cost of one PBI in the experience account at any one time, unless the account has grown with interest and we have not met the other criteria necessary to grant the PBI. But I can't, as the actuary, put in more than enough to grant one PBI. So if we have some money in the experience account, and just hypothetically, if it costs $12 million to grant a PBI, and we've got $8 million, and I'm allocated $10 million excess, I can only put $4 million into the experience account, enough to get us to the cap. So if there's any of our allocation left over after we've met the cap, then that excess goes to reduce the oldest outstanding balance of the oldest amortization base that we have on record. If our allocation does not bring us up to the cap, then we get the full allocation. But if we're short in any one year and we have excess interest earnings that are allocated to us, we can always top up to the cap. And the cap will be calculated or recalculated every year. Because every year we're losing people through attrition, retirees that pass away. We're also getting new retirees that come on board that could meet the criteria for a PBI. Now, what I've just described to you with regards to how the experience account is handled and how we allocate these excess interest earnings does have a rather significant impact on the funding of the plan, and we'll see that in just a minute. But just to finish covering the impact of Act 399, what you do need to know is that the cap, the cost to cover one COLA, is the amount necessary to grant a PBI up to some percentage. And the percentage that you can grant the PBI on is based upon your funded status, plus the supplemental 2% for those over age 65. It might be helpful if you turn to page 5, because that gives you the chart of what those percentages would be. And what it shows you is the old law provided for versus what the new law provides. And just concentrating on what the new law provides, you will see that what this chart is telling us is that if you are less than 55% funded, then you're prohibited from granting a PBI. If you are between 55 and 65% funded, you are limited to the lesser of 1.5% or the CPIU, whichever is less. So if the CPIU for that particular year was 1.2, and you have enough money in the account to grant a 1.5, you're limited to 1.2. In the year that you grant the COLA, you still have to meet the actuarial rate of return or the discount rate from your investments in order to be able to grant it. If you're between 55 and 75% funded, they've increased your cap from 1.5 to 2%. So now it's the lesser of the CPIU at 2%. And if you're between 75 and 80% funded, it moves it up to 2.5%. And finally, if you're over 80% funded, the cap is up back to its original old law, 3% max. So what they've done is they've scaled back the amount of PBI that you can grant based upon the funded level, which is another way of saying that you have an incentive to increase the funded level so that greater PBIs could be granted to the membership. I guess the other way to look at that is that if you aren't as well funded, then we're going to restrict the amount of PBI you can grant the membership.
Charles, I guess the way that it works is right now based on this report, we're at 65.5% funded.
We're getting there.
So we would be in that line item going across there, that 65 to 75. But how does it work as far as you use the 2% because you don't know what the CPIU?
You're giving me a really good segue into the next page, so we'll cover that.
Okay.
Because it's very, very complicated, and that's why I'm taking the time to do this and go through this section before we get to the actual funding, and because this does impact the funding. Just as a side note, that Act 399 did change the maximum benefit amount that PBI can be granted on. Right now it's at like 94,414, something like that, and they've reduced that down to 60,000. But that 60,000 will be indexed as the years go on. They've also put a provision in that you have to wait a year from the year in which you granted your last PBI. So we granted a PBI this past June 30, effective July 1st. So now we have to wait a year before we can determine whether or not we can grant another PBI. And when we make that determination, it's not payable until the following July 1st. So actually, it's like a 2-year lag. Okay, so you are having to skip a year. Whereas before, under the old law, if you had the funds available and you met the criteria, then you could virtually give one every year, provided you had the funds available. Other than that, there's not too much more. I mean, there are other things in the law that pertain to us, but those are the most important things. There is one caveat for this year, and it only applies to the June 30, 2014 valuation, in that $5 million hurdle this year and this year only. We're taking that hurdle and we're splitting it in half. And $2.5 million of it is going to be amortized as an employer credit over the next 5 years. Remember, I said the full $5 million hurdle was applied to the outstanding balance. Well, for this year only, we're gonna take $2.5 million of it and use it as an employer credit. The other $2.5 million will be applied to the outstanding balance.
So what does that do for the employer?
It reduces the contribution.
By about how much, just curious.
We'll look at that, but it's not a large amount of money. I'll point it out to you when we get to that page, and we're getting there quickly because I can see all our answers.
Charles, the $5 million hurdle, is that's specific in the act, the $5 million, or is it calculated?
It's specific in the act, and it will be indexed going forward based upon the actual rate of return. But for the first year, this year, it is $5 million.
Is that the same for all the retirement systems?
No, this act only applies to the 4 state systems. Those are the systems that have a constitutional guarantee on benefits. Each of the state systems have a different hurdle. I believe teachers' hurdle is $200 million, state employees is $100 million, school employees is $15 million, and state troopers is $5 million. Teachers and state employees have hurdles, so this was not a new concept for them. It is new for school employees and state police. If you'll turn to page 6, we've already indicated in this Act 101 that did this, that we were able to grant a PBI for our retirees and survivors at the qualification, and we were able to give them a 1.5% PBI increase, and if they were over age 65, we were able to give them the supplement, 2%. We also had Act 859 that passed, that got a lot of notoriety. As you all know, Judge Clark ruled that unconstitutional, and therefore it's been excluded from this valuation report. What I did do, the next item, it says side funds. This used to be in the financial section, and I moved it up front because of the complexity with which Act 399 has imposed upon maintaining and accounting for this side fund, in particular the experience account. So let me walk you through this experience account. We started at the beginning of the year with a balance of $18,164,000. We paid a PBI that was effective June 30th, 2014, but not payable until July 1st. And that cost us $8,362,000. So the purpose of the experience account was to fund this PBI. So we take that amount of money out of the experience account. And that's why you see the negative sign, because I'm drawing it from the experience account. But the experience account earns interest at the same rate that the assets of the trust earn, the actuarial rate. And so we add to that $18.1 million the interest that it earned, which was $2,267,000. So on June 30, before I take into consideration any new allocations of excess interest, I had a balance of $12,069,000. Now, we had a good year and we had excess interest earnings. And after I deducted the $5 million hurdle, I was able to split the excess above that $5 million hurdle into 2 pieces. The piece that is allocated to the experience account, $16,675,000. But before I can put that into the experience account, I have to check and see exactly what a PBI, a new PBI, is going to cost us. So I look at all of
And when you figure out how much it's gonna cost, are you looking 2 years down the road?
Well, that's the tricky part. What I actually do is look at all of the current retirees that are age 58 years old and older. Why? You can't get a COLA till you're 60. But 2 years from now, these people will be 60. Okay? And that have been retired at least 1 year. Well, all of these people, since they're already retired, 2 years from now will have been retired 1 year. So I know all of those people would be eligible. I don't know who's going to die, so we don't project that.
I thought you knew that kind of stuff.
Hmm?
I thought you knew that kind of stuff.
I'm sorry, I didn't.
I thought you knew that kind of stuff.
No, only the Italian actuaries can tell you who's going to die and when they're going to die. I just can tell you approximately when you're going to die. I also look at the current survivors and of course our current disabilities. I can't project future disability retirees. I can't project future survivors. I can only look at what we have on board today. I can't project any current active people retiring.
Do you take into consideration that they close, I don't have any of them that's even close to 60, I guess?
I have a couple.
Yeah. I guess the ones that are close to 60, you take that into consideration, I would assume?
Not if they're currently active. And all I can do right now is price those who will be eligible based upon the criteria and the census that we have available right now. We're not allowed to make any projections in this cost. There is a mechanism that allows us to top up as we add active members that do retire, that may become eligible in the next year. But also keep in mind that we're going to probably lose some people through attrition. So there's some dynamics that are going on here. Well, I priced that, but before I priced it, I had to know what our funded percentage was going to be. Because keep in mind, our funded percentage determines whether we grant a 1.5%, 2%, or 2.5%. So we haven't gotten there yet, but Erwin's already indicated we're above 65%, so we are in the 2%. So I've priced the 2% PBI with the 2% supplement, and that would cost us $9,971,000. And this is based upon a maximum pension benefit of $60,000 without projections in the $60,000. We know it's going to get indexed up every year, but we don't know exactly what that's going to be. I currently have an experience account balance of $12,069,000. So I am now prohibited from putting any of this $16.6 billion into the experience account because we have more than enough to grant the next PBI. The next PBI is going to cost $9.9 million, and we have $12.1 million. So I can't use any of that $16 million excess. So I have to let it revert back to reduce the outstanding balance of the oldest amortization base. And that leaves us with an experience account balance of $12,070,000. This is exactly what the author of the legislation intended to have happen, and it works. And we've seen it work. Now, how does that impact us relative to our funding? I'm going to ask you to turn to page 12. And you're going to hopefully refocus want you to look at all of these numbers. I just want to explain to you that each year, when our liabilities change because of experience or change in infrastructure, we have to measure the change in the unfunded food liability and amortize that incremental change. So we have a series of amortization changes that take place because there's always dynamics going on, and from the standpoint that perhaps salary didn't increase as much as we thought it was going to increase. Maybe more people died than we expected. So there's always these incremental changes, and these incremental changes keep us in step with the proper funding. What I want you to focus on is, if you look down that description, you'll see that there's a date that each one of these changes took place. And in near the bottom 2/3, you'll see a 2014 entry for Act 399 of 2014. And you'll see that there's an entry of a credit of $2.5 million. And that $2.5 million is being amortized over 5 years, and it's reducing our employer contribution rate by about $600,000. You'll see that the other half of the $5 million is just being used to reduce the outstanding balance. There's no corresponding reduction in the contribution rate because it's being applied to the outstanding balance. You'll also see that because we have reached the PBI cap, our $12 million experience account balance exceeds the amount necessary to grant the next PBI, that I now have to apply that $16 million as an offset to the oldest amortization base. So now I've got two entries in here that have reduced the oldest outstanding balance amortization base. And those two entries add up to about $19.1 million. Okay? Are you with me there? Now, if you look at the top line, under 1993, you'll see that that exceeds the 1993 amortization outstanding balance. So it pays it off. And you see that the payment is now zero. It was about $2 million. So the impact of dedicating these two amounts to the oldest outstanding amortization base paid off one of our bases, the oldest one, and now we don't have that base to pay on anymore. So that reduced the employer contribution rate. Now, I wanted to go through all of that, all of this, so you would kind of get a better feel for why and where we are relative to the funding of the plan. So if you now skip back to page 2, unless you have any questions.
Well, and so I'm assuming that the difference of, say, 600,000 went and paid off the next one, right? You adjusted the next one.
Well, what you don't see here, and what I do have, and if you'd like to look at it, is the amortization base for 2015, or that schedule, that projected schedule. And what it does is it takes those two bases that were about $19.1 million, and it deducts that 18.5. That leaves me a residual of about $600,000. That $600,000 is still being used to offset the oldest amortization base, but it won't be applied until it grows an amount equal to the next oldest base, which is the 17.4. Right. We skip the credit base and go down to the next oldest positive base.
So it won't eliminate, it won't be subtracted off of that right away. We have to wait until we get the next
Right.
big pile.
Right,
Okay.
and so if you want to see what that looks like visually, and we can certainly pass this around if anybody's really interested in it. But what you'll see is, I've got an entry in here, and this is the amortization schedule for 2015. That instead of having that that hurdle entry, I've used that hurdle entry, and I've used the $16 million entry for reaching the cap, and I'm left with an accumulated value, okay? And the accumulated value, I'm reading it upside down, is, it says it's 617,000, but you see, with the outstanding,
Yeah,
it grows with interest.
okay.
Okay, so, because all of these bases grow with interest.
So is that, why? Just that's the way the formulation has to go? Okay.
So we'll keep accumulating any more credits to the,
And that would add on to that?
It would
if
add on to
doesn't
that.
add up to the 17, or until it ends up to the 17?
we'll just keep adding them. And that's what's going on in all of the state systems. We're just keeping a running track of how much is available to pay off the oldest balance, but we don't actually do it until it
Got it.
accumulates enough. It just so happens that this is the only fund of the four funds
Yeah, it has the
that
leftovers.
can pay
Yeah.
an old outstanding amortization balance. The reason why is teachers and state employees have initial unfunded accrued liabilities and that experience account unfunded accrued liability. These are huge numbers. State police paid off their initial unfunded accrued liability with the outstanding balance of the Texaco settlement fund. So we have no issue. This first balance that we paid off was an experience differential. $18 million. So it's good because it pays it off, and now that's one less amortization schedule we have to worry about, and it also reduces the employer contribution rate. So let's turn back to page 2, and I promise you we're getting close to the end. I'll go through page 2 and page 3 and just make a quick comment about page 7 and we'll be done. On page 2, what you see here are what I consider to be the more important numbers that are developed in the valuation. It's not consolidated on this page with comparable results from the prior 2-year valuations. You can see from the membership census that the number of retirees declined slightly, which basically means we had more pass away than we had retire. The number of active participants increased. No big surprise there because we had a graduating class that we now have enrolled into the pension fund. The number of terminated vested declined slightly from 37 to 34. Annual benefits, this is the rate of pay on June 30th. We may pay out more during the year, we may pay out less, but we were paying at this rate on June 30th on an annual basis of $40.4 million. Total payroll, the rate of annual pay on June 30th was $54.3 million. It increased over last year, obviously because we had the graduating class come in. So that's an important concept because we're spreading some fixed costs. 3/4 of our costs are fixed costs, meaning they're amortization schedule costs, fixed dollar amounts that don't float with salary. So if you increase your salary base, you're spreading that cost over a bigger base, which makes the percentage go down. Our valuation assets increased from $474 million to $549 on the back, and that comes on the back of market returns of 17.93 and an actuarial rate of return of 12.48. So we had a very good year in that respect. For the 2 remaining people that had drop account balances, that are active and drop, that are still active and had drop account balances. there still may be some older participants that were in the old drop. They will receive 0.5% less, or 11.98% on their drop accounts. Our experience account balance, we've been over this, it's a little over $12 million. So we do have enough money in there to grant the next PBI. We have seen that the normal cost has declined slightly as a percentage of pay, 28.29 dollar amount increase, obviously because of the introduction of the new troopers that came on board. But the important thing is that the cost for normal costs, which are our annual accrual of benefits, how much does it cost each year to accrue another 3 30% of your final average compensation? It's staying relatively constant, around 28%. That's the important thing. Our unfunded accrued liability, based upon our very good performance last year, decreased from $323 million to $288 million. And that brought us to a funded percentage of 65.5%, which is very good. It's good because it's healthier for the fund, but also it helps you with regards to your ability to provide meaningful PBIs to your retirees. All of this has generated a contribution rate for this year that should have been 66.7, but in fact, because we have to project these rates a year in advance, you're actually contributing at a rate of 75.3% this year. So you're actually contributing about 8.6% more than what's needed. And that additional amount that we'll get in is going to represent a contribution variance. That contribution variance, it'll be a credit, will be amortized over 5 years, and that amortization payment will be applied to the employer contribution variance account. So there will be another reduction in the employer contribution, and that's reflected in the projected employer contribution, because an old variance fell off, which is a very large positive variance, and we're adding a new negative variance on there. So it's a rather dramatic decrease in the employer contribution rate from what actually should have taken place of 66.7 to 60.8, but in comparison to the 75.3, it's a rather substantial reduction.
I want to say so.
So,
Plus, he got, or they get the 2.5 million as an addition. That's done up to 5 years.
that's built into
Within
this
here,
rate.
so, I
This is
mean,
built
all
into
the
that.
above.
Right.
Yeah.
Well, that's why I went through all of that, so I could show you that the 2.5 million that's being amortized over 5 years reduced this amount.
And
The 16 million and the other half, the 2.5,
takes off the
took
top.
an old base and got rid of it, and that was about a $2 million payment per year that we would have paid over the next 14 years. So that's gone now. So all of these things, because of Act 399, have helped reduce the employer contribution rate by the way that they have reallocated some of this excess interest earnings. And of course, we still continue to get the insurance premium tax allocation.
So 60.8, that should be very grateful when that first happened.
Well, I think a good number of people should be happy.
Well, they certainly watch that number as much as they do anything else because of the magnitude of the impact that it has on the state budget.
And let me just give you a little insight going forward, just as a sidebar. And what I've done is quickly turn to page 14. You don't have to if you don't want to. But the actuarial value of assets for funding is at $549 million. You may recall our market value is at $622 million. There's about a $70 million swing there. And what's going to happen over the next 5 years, or really the next 4 years after this year, because of the actuarial smoothing, we're going to be smoothing that $7 million
forward.
into the fund.
Yeah.
So that's going to help
Help,
us
yeah.
further reduce the employer contribution rate, provided we don't have any really bad investment years.
Yes.
Well, you cannot, but guess what? Today the market's down 400 points.
Okay.
So
I know
it's
you
already below 16,000.
We won't.
Thanks, Joel.
Okay,
It is what it is, and we've got to just face up to these things. But we've got, you know, 9 more months
Yeah.
before the end of this fiscal year, so hopefully we can get that shit right.
Okay, can I ask you one question?
You can ask all the questions you want.
Kind of going back, so the actuarial rate is, what is it, 12.48, right? On the
Talking about
fund.
the rate of return.
Yeah, actual rate of return.
Yeah.
So if we, for, now, this little, graph on page 5, where if we do not make 12.5,
No, you don't make 7. It's relative to the discount rate.
it's relative to the discount rate.
Right.
Okay, that was where I always get confused, because you say actuarial rate of return, the system does not earn,
There's-
you get
If I
none,
said
right?
that, then I misspoke.
Well, no, that's what it says here. System does not earn ARR, you get none.
Then I
So,
miswrote.
is it ARR or the
No, it's
discount?
the discount rate.
Oh, shoot, good, because, I'm thinking,
Uh,
okay, so on this graph on page 5 for Act 399, if the system does not earn the discount rate, which is 7+,
Yeah, it's actually the actuarial valuation rate or discount rate. They're synonymous.
okay, valuation, that's what you, yeah, so put AV or
Yeah.
ARR. Okay, okay, so that makes more sense,
I have
because,
dyslexic fingers.
hey, I understand, no, that just makes more sense, because if we don't, I'm thinking, my lord, that, 12.48, we, hopefully we'll get there, but we don't have to worry about that, it's the 7%.
Well, you have to make the 7%,
Yeah,
not
so-
this year. Next year.
Right,
The year
yeah.
after that, because this coming year, you can't grant a college.
Okay, so it doesn't count now, it counts the next
And the
year.
year that you
Okay.
want to grant
Okay.
PBI.
Okay. So, all right. Okay. All right, I'm good. I'm
Good.
all right, now I'm set straight, because I got a little confusing.
Okay.
Okay, so we're on page.
You're on page 3. Page 3 really does nothing more than give you an explanation of why and how the unfunded accrued liability changed. We start off at the beginning of the year with an unfunded accrued liability of $323 million. There are things that cause that unfunded accrued liability to increase during the year, and there are things that will cause it to decrease. There are a lot of moving parts. And so what I try to do is identify for you the more important moving parts so you can see the impact that they have. That unfunded accrued liability is money we should have in the bank that we don't have in the bank. It's measured against our liabilities. And therefore, it's the result of discounting the liabilities. Those liabilities are discounted at 7%. So as time goes on, it earns interest at 7%. So it increases. That unfunded accrued liability increases at 7%, $22.6 million. The experience account balance, even though we didn't have an allocation to it, it did earn interest. So we have to put the interest that the experience account earns as an increase in the unfunded accrued liability, because that interest didn't go to reduce the unfunded accrued, it went someplace else. We did grant a PBI, and that cost us $8.3 million. And we had an experience gain from all other sources other than investments of $4.3 million. So that helped reduce, excuse me. It increased. So now we're left with decreases, which is, I've got another dyslexic finger. The decreases are the investment gain of $38.3 million. We also gave back to the trust fund, out of the experience account, the 8.3, million that it cost for the COLA, so that it was zero. It increased it and then we decreased it. The employer shortfall gain was $2 million. That means that we received $2 million more than we expected to receive because of the fluctuation in the employer contribution rate. And the net amortization payment, which are the payments made to the unfunded accrued liability that we received during the year, reduced the unfunded accrued liability. And those payments were $32.3 million. So we had more decreases than we had increases for a net reduction to $288.8 million. Now, for all practical purposes, that concludes the presentation, except that I have to, because of the new disclosure rules, indicate to you two things. One, we do include the new FASB accounting for 67, 68 this year, but I also retain the 25, 27 accounting, just in case there was some transition numbers that needed to be placed. Those have now all been placed at the rear of the valuation report in Exhibit 6. These are the same exhibits on page 32, 33, and 34 that you've been used to seeing for GASB 25 and 27. It just reiterates much of the information, if not all of the information we have already discussed. It's just put into the various charts that the accountants require us to disclose. Page 35 is new. They have introduced something called a net pension liability, and that differs from the unfunded accrued liability in that the net pension liability is the difference between our accrued liability minus the market value of assets, where our unfunded accrued liability is the actuarial value of assets deducted from the accrued liability. So one is market value of assets, one is the actuarial value of assets. I've already indicated to you that the market value is about $70 million more, so the net pension liability is going to be about $70 million less. And we go through the same allocation of gains and losses for the accountants on the bottom of page 35. We're also required to disclose whether or not the discount rate that we are using is appropriate for GASB purposes. And I have determined this year that it was appropriate. But I can't just say that willy-nilly. I have to demonstrate that it is. And if through this demonstration I cannot satisfy certain criteria, then I have to adjust the discount rate for GASB purposes only. And there are specific instructions as to how that discount rate has to be adjusted. One of the things that they require you to do, and I'm turning to page 37 quickly, is they require me to take the current population and project it out and to see when and if, under the current population, without regards to any new hires, but just the current population, is there going to be a period of time when we run out of assets to pay benefits? So what you can see is I have projected the benefit payment for, well, at least the year 2033. They wanted you to do a 50-year projection, but it became a moot point after after the year 2024. What this is showing you is that on a projected benefit payment basis, just for the current population, we will achieve a fully funded status by the year 2024, meaning that our market value of assets will exceed our accrued liability in that year. Had that not happened, and we had run out of money anywhere in this projection, then I would have had to have recalculated the discount rate for GASB purposes using the municipal bond rate, AA rated bond rate, which is around 5%. And I would have had to have recalculated what the appropriate discount rate would have been using that lower interest rate for those payments after we ran out of money for the accrued liability. Page 38 just shows you how I arrived at those projections for the active members and for the retirees. Page 37 takes these two and adds them together for you. That's all it does. And then another chart on page 39 for our accountants. This is disclosure information relative to the actuarial required contribution versus what the actual contributions received are. Keep in mind that we operate on a projected rate. The actual rate is based upon what should have happened, but we don't find out what should have happened until I do the valuation a year later. So it's important to them, not so meaningful to me. I'm more concerned about, are we making our promise to fund the system by paying the contribution rates that we've set. The last thing that I have to disclose to you is that is back on page 7, and it's that last paragraph that I am required to tell you that I am a fellow of the Conference of Consulting Actuaries. I'm an associate of the Society of Actuaries. I'm an enrolled actuary with the joint board for the enrollment of actuaries under ERISA, and I'm a member of the American Academy of Actuaries, and have met the qualification standards of the Academy necessary to render this actuarial opinion, or opinions that are expressed in this report. And that concludes the presentation, unless you have any questions.
Dr. Cross. Okay, I want to make sure I understand on page 35, the pension, the ending pension liability that you calculated for GASB 67 and 68. We're comparing that to the actuarial unfunded liability on page 3.
That was the distinction that I was trying to make, but I admit I blew by it really quickly.
Okay.
All right. If you will look at the middle column near the top of page 35, you'll see a net pension liability of $215 million. Okay? You see that number? That number is comparable to the number you saw on page 3. Roman 8, 288 million. What is the difference between those two numbers? One is 215 million, one is 288 million. The difference is the difference between the market value of assets and the actuarial value of assets. The market value of assets exceeds the actuarial value of assets by about $70 million. And the accountants want the disclosure to be on the market value of assets, because what they're trying to accomplish is to compare public retirement funds across the United States. And for them to get a meaningful comparison, they want the valuation to be done using the entry age normal cost method. Well, good for us, we were already there. We used the entry age normal cost method. So we didn't have to make a change, or I didn't have to do another calculation using another cost method. They also want us to take the accrued liabilities that you've calculated using the entry age normal cost method. We take those accrued liabilities and subtract off the actuarial value of assets to get our unfunded accrued liability. The accountants want us to take that accrued liability and subtract the market value, which was $70 million greater. So they're showing a net pension liability of $70 million less.
That's not what we were expecting to see, right? I mean,
It
from
is
what
what
we
we were
heard
expecting to see.
at Lapers, it seemed like, everybody was really concerned that once we did the GASB 67, 68, that our liabilities were gonna look so much higher than what we're seeing.
What
in
they
our
were
actuarial.
referring to does not really apply to state police. It does apply to teachers, lasers, and school employees. if this had been a multi-employer fund, and what I mean by a multi-employer fund, let me just digress to one of the other systems. School and boards, teachers. They are multi-employer. All the school boards and charter schools contribute. So they are the employers that make up the multi-employer. We only have one employer in this fund. So that employer is responsible for all the liability, and they have to, this employer has to put it on its financial statements, our capital. What they were referring to in Lakers was each of these school boards for teachers and school employees will now have to take this net pension liability, and we would allocate that net pension liability to each one of these school boards by a form, and they will now have to take their allocation of this
On there.
unfunded liability, net pension liability, and put it on their books. They never had to do that before. So now their financial statements are going to look really, really bad compared to the prior year. And that's what they were moaning and groaning about at Lakers, because few are prepared to
Well,
make this adjustment. And it's going to impact their ability to
borrow money.
issue bonds and things like that. It's, until the rest of the markets kind of catch up with what's going on. It's a hugely, hugely unfair thing, in my opinion, that GASB has done to these multi-employer public plans. And I'll give you a quick example. They're being allocated a portion of this net pension liability based upon what they contributed last year. And you say, well, gee, that doesn't sound that unreasonable, because the contributions are, the funding's based upon how much each contributes. But these liabilities are based upon lives, that have been growing for many, many years. This unfunded accrued liability just didn't come about overnight in this last year. It's been growing and building year after year. Well, if you're like a charter school that just started up last year and you contributed last year, you wouldn't have any unfunded accrued liability because you've contributed everything we've asked you to contribute. So your unfunded liability, if we recorded it individually, would be zero. But yet you're going to be assessed, because of your contribution level, a percentage of this whole unfunded net pension liability. And so now you're being assessed $20 million, at teachers or something like that.
Right.
It's a bad situation, because the assessment aspect of it didn't take into consideration how the liabilities were grown.
Right.
So it's an unfortunate thing, but I'm sure they'll do something to address it in the future.
Charles, the process that you just described and went through with us relating to GASB and the changes there was exactly what FASB did about 27 years ago to the corporations, to the private sector. And it's exactly what was the demise of defined benefit plans on the corporate side. It's why you no longer have defined benefit plans there, because they couldn't afford to reflect at market those liabilities on their income balance sheets.
Yeah.
So it has huge implications in my mind for the public sector.
Yeah,
And,
it does. It's a matter of public record, and I wish I had brought one with me just to show you. But for the school employees valuation, what's missing from your report, but is in their report, there's 5 pages that follow this last page. And those 5 pages in school employees shows the allocation of that net pension liability to each one of the school boards. And it's frightening.
It's what's going to really hit home with those
Oh,
guys.
yeah. So unless you have any other questions, That concludes my evaluation. And
Yeah, Charles, just for the knowledge of some of the guys and ladies who have been on the board previously, you'll take this upon our approval today to the PERSAC committee. And that will be in
it would
November.
be my hope that the board would approve this valuation. And if you do, my intention would be to recommend to PERSAC that they set the employer rate for the 15-16 plan year at 60.8% plus the insurance premium tax allocation of $1.5 million.
Can we change this like 40% instead of 60?
Oh, heaven. And then the drop rate instead of 11.9. I'll make that motion.
Got a motion by Ms. Amy that we accept the actuarial report by Charles. Any a second? A second by Thurman. Any objection? See none? So moved.
I would like to thank the board for moving this up on your schedule a month early, because as it turns out, PERSAC is meeting on the day we would have met. So,
Well, and they'll be meeting that afternoon also.
well,
It would be pretty tough to get it approved and down.
That's right.
Same day. Thanks, Charles.
thank you.
Did I say that? Okay, she's gotta change the tape. You wanna wait a second? Hey, Charles, make that change.
I will.
Would you?
I will. I made a note.
Okay, good. Appreciate that. Kind of just freaked me out, because I was getting confused, not here, even at Lasers, and I'm thinking, God, if we ever had to do the extra, I was like,
You know, what really freaks me out is when you sit down, this was a very unusual year because things were late and everything, we had to do it in time to rush, which is no excuse. But I sat down and this was after the review evaluation, and I found a critical error in the amortization schedule. So, late yesterday afternoon and this morning, early this morning, like 5 o'clock this morning, I was tearing these reports apart. Slipped in 4 repages.
I hope it was to our benefit.
It was.
Good.
It was working.
It was.
Well, it
We
just
would
needs
have
to
delayed
be
the
right.
meeting for you too.
It just needs to be right, that's all. And so,
Good deal. Thank you again, Charles.
Thank you. Appreciate it.
Charles. And you get an hour.
Of course. Good to see you.
All right, we want to item 9 agenda, date of board elections.
Under tab 6, I just gave you a copy of the bios that we sent out, or that we will be sending out. Everything will go out in the mail tomorrow. This is the first time that we've actually had 2 elections going on at the same time, and that was because, of course, Ms. Shirley passed away. So that left her seat vacant. She would have been up for re-election in June of 2015. So what we're doing with her position is we're asking for someone to fill the unexpired term and the new term. And then for the active position, which is the seat that Kevin Marcel holds now, that position ends on December 31st, and so we're asking, for candidates for the next 5-year term. So what I did in your packet was I just gave you the bios, just to kind of let you know who's running. We've got 3 individuals that are running for Kevin's seat, including Kevin. And then we've got 2 individuals that are running for the surviving spouse seat. So those things will go out in the mail on tomorrow, and then they have about 2.5 weeks to get back with us to get their ballots marked and get them in, and then we'll be tabulating ballots in November, and hopefully we'll be able to, if we don't have any runoff elections, we'll be able to introduce the new trustees to you at our December meeting.
All right, You said, the one out with the ballots is this right here, there, little.
Yeah, this is just under tab 6, this is just letting you know what we're sending out with the ballots. In their envelopes, they actually have a ballot, a return envelope, and these bios, just to let them know a little bit about who's running.
That's like,
Yeah, I guess as far as the voting, I was kind of concerned, I was looking at it earlier. As far as the surviving spouse position, and none of us never heard these names before.
Yeah.
We have no clue.
I know, that's actually why this year we decided to put bios in the envelopes with the ballots, because the way that the law reads, the people who vote for the surviving spouse are the actives and the retired. Well, a lot of the retired people know these surviving spouses just because they knew their husbands. But a lot of our active guys have no idea who these people are. So that is an issue and a problem.
They're not gonna vote, they're not gonna even.
We have a problem every year. I've been with this retirement system for over 15 years, and we have always had issues with getting people to return their ballots, no matter what election we have.
On a good election,
Yeah.
the returns are about 20% or less.
Yes, we're
In
sad.
ballots. So, I don't understand the thought process that because I don't know anybody, I wouldn't vote for anybody, The way I would look at it, I would call somebody, and we get calls from time to time, and we try to be as fair and impartial as we can. But we'll take, Marcia, she's given us a little bio here, but, obviously she has been Pressburg's widow. Miss Doris Prudhomme is a lady that I have known now for about 12 or 13 years since I've been here, and she's been very, very active at all of the LSTA conferences and conventions. She's always there. Those kind of little things tell you about a person's commitment and their desire to serve. So, there are some things we can help you with in that regard, but I would encourage everybody, and please, those members of the board that are active, please let your fellow troopers know that they've got a responsibility to vote. It's pretty sad when less than 20% of the troopers and less than 20% of the total retirees and troopers vote on these elections. But that's
Even
the
for their
statistics.
own.
That's,
Yeah.
that's on, as far as the state police as well, but I guess my concern, and you just told me a lot, but, nobody, I just know they're not gonna be interested because they don't know anything about them, your actives. But that doesn't, I understand now, as far as
The impact on our system is pretty tough.
Yeah, that surviving spouse seat in particular is so important to this board, because that person, since that seat was created, and I was here when it was created, the person who has filled that position, Ms. Shirley, Ms. Sharkwa, they are always here. You can always count on them for a quorum. They will, they're always willing to serve on committees. They're, they don't have the, they usually don't work. They don't have jobs. All of us have positions. Sometimes your duties for your job will take you away from this meeting. Well, not them. They're always here. So that person or that seat has become so important to us as a board, just for the fact that they're always here, they're always interested, they're always counted as a quorum. So I would hope that people would take an interest and would vote, and I'm trying any way possible to get them to become interested, which is why we included the bios this year. I'm hoping they'll take time to read those and learn a little bit about the candidates, and maybe that will help a little bit. And I'm going to track the percentages this year, Thurman, and see if maybe that increases our percentage a little bit of people who actually return their ballots. So we'll see how it works.
it's simply an email from us to all the
Just encourage
the
you.
family. When I say the family, state police family, they'll respond to us, but they're not gonna, I just knew they wasn't gonna open that up and
I would encourage each of you as board members to do that. Reach out to them and let them know that it's important to the future of this retirement system and to the representation of all aspects of the makeup of our board that they do that. So,
And I can share, if you think this would help, an electronic copy of these bios
Can you email
to
it?
you, and maybe you could send that out to people you know and just tell them, hey guys, this ballot's coming down the pipe, here's your bio, this is really important. So I'll send that to all of y'all.
We have a master list, we just plug it in and send it to them, and they'll read that, but I'm concerned, I was concerned because they don't know anything about them.
Yeah. Yeah, we're always concerned too, so, maybe all of us working together, we can get a larger number of people to vote.
How'd you get the names, Kim?
We send out a letter and we ask for people who are interested to qualify as a candidate by sending a certified letter to us. And so those were the 2 that responded, and then of course with Kevin's position, we had 3 people who responded.
It's good that you receive responses.
I know,
Because when Miss Shirley ran for her 2nd term, she had no one who opposed her. So because she had no one who opposed her, I was very concerned, that we wouldn't have anybody, but we had Miss Pressburg and Miss Prudhomme, both great candidates in my opinion. So we'll see what happens.
Approval of the 2015 board and committee schedule.
Okay, the proposed schedule is under tab 7, and we've changed things up a little bit this year because of what we discussed at the last board meeting about the way the PERSAC's going to meet now. So now we're going to have our board meetings beginning in February every other month instead of, in the past, we've had them begin in January every other month. So we just really kind of switched out, and the board meetings are going to be bi-monthly beginning in February, and the investment committee is going to be bi-monthly beginning in January. We've also taken into consideration holidays, just like we do every year, and we've also taken into consideration the dates of labor so that we wouldn't conflict with that. So if you approve this schedule, then by law, we're required to send it to the legislature and out to the other retirement systems, and we will be doing that upon your approval.
All right. Most of these are go on Wednesdays.
all of them.
Yes, all on Wednesdays at 1:30, and then the investment committee at 9:30.
Any questions?
I'll make a motion.
Motion by Kevin. We accept the meeting schedule, second by Thurman. Yeah, Jack.
Yes.
Mr. Bill to approval, can I get a motion to go into executive session?
I'll make that motion.
Motion by Sue, said that?
Me, I'm sorry.
Motion by Sam, second by Steve.
Yay.
And Jack.
Before we start on this, would anybody have opposition to taking like a 5-minute break?
Yes, please.
No.